Should we buy or sell the Financial Services ETF? First off, read this disclaimer carefully. Then do your good deed of the day by liking and subscribing. So in the Financial Services ETF category, we have a bunch of ETFs. The US Financial Services ETF, it has the ticker XLF. We are basically at the 52-week lows, minus 27% away from the 52-week highs. As such, we are definitively in bear market territory. So this is the big picture, weekly data points, and we can go pretty far back. I think it's very important to go back here to the global financial crisis. So what you saw here is that if we just draw a bit with the handy tool, the red 200-week moving average, it was, an important level. Then you see 1, 2, 3, 4, 5 times it was tested as resistance and resoundingly confirmed as resistance. And that is when really the shit hit the fan here. It just kept going down, 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 and the purple 20-week moving average was like the pressure level throughout. As long as we were below the 20-week moving average, you could basically just stay short. Then you see here, quite far into the future, frankly, in 2012. Then you see here the red 200-week moving average, a bit of a resistance, but then it became support, and then you do get a very strong rally in the XLF. Play around with the moving average again, then we go to rally after confirmation. Boom, we test, confirmation, bulls are back in the game, and here we play around with it again, but now we got a situation. This week, we clearly closed below the very important red 200-week moving average. You can see here on the candlestick itself is that the upper end of the candlestick, it almost surgically tested the underside of the 200-week moving average. So this is a bit of an ugly rejection. We have seen in the past that losing that moving average can be pretty bad. So currently, this looks like what we have seen before, and that was not a good time for the XLF. That doesn't mean it will happen again, but it means that this setup has a precedence that is not favorable to the bulls longer term. To be perfectly clear, there can be rallies throughout. Looking here at the daily data points, you see here that RSI it's at a low that back here in mid-June, we did get a pretty decent rally from those lows. We got, from a low here, 16% rally. Back here as well in late May, you got a strong rally, but it was a bounce within an ongoing primary downtrend. So what I write in my notes is 200 weekly moving average resistance, but we are oversold on daily RSI. So in this case, I give the bulls a short-term 3, but to be perfectly clear, as we saw, bigger picture, this is not a good setup. Let's look at the seasonality. To the right here, we do see that in green over the last 5 years, blue over the last 7 years, and red over the last 10 years, the seasonality is overall rather bullish into late December. That's bullish. To the left, we do see that October, which started today, and November, December, January are some of the strongest months for the XLF. Over the last 10 years, October, November, and December are the 3 strongest months. Big picture, last 20 years, October is the second, well, it's the third, frankly, strongest month. November is no weak either. Then December comes with a bang, which is the strongest month. I give the bulls an 8 on the seasonality. The facts are what they are. It is clear that bigger picture, looking at the charts, we do have a downtrend, but the seasonality is what it is. It's very strong, leading all the way into the end of the year. Let's look at the fundamentals. So I am comparing the IXG, which is the iShares Global Financials ETF, with the XLF. Looking at performance, year to date, global financials are slightly underperforming the XLF. The beta is, however, a bit lower. The PE is significantly higher though, so the XLF is cheaper. Looking at the yield, XLF also wins on the yield. Looking at the holdings, there are some that do repeat some of the very large companies in the space. So here you can see the sector breakdown, market cap, regional breakdown. You see that the global one is nonetheless very dominated by American companies. And United States accounts for 50% of the IXG. I will give the bulls a 3 here on the fundamentals. Now let's look at relative performance. So I am comparing the XLF against the S&P 500, and long term we have a 93% positive correlation. Looking at the IXG, the global financials, then we do have 99% correlation, so pretty strong. 50% here with the 10-year yield, minus 9% with the dollar index. Daily data points, short term 96% S&P 500, 98% with IXG, minus 76% with the 10-year yield, and minus 82% with the dollar index. So what happened with the IXG is going to have the biggest impact on the XLF. So here is the IXG. The first thing that jumps at me from the chart is definitively these time cycles that have been, fairly reliable and tradable, easy to go long and go short. The declining cycle is sort of supposed to end, and, we are supposed to have a rising phase around the corner based on these time cycles. Let's look a bit at, the RSIs and PPOs. If you look here at, the green 50-week PPO, you see here that back in 2018 and 2016, the current level formed, key lows on the time cycles. So it's interesting. It's something to just have in mind. It doesn't mean it will happen again. Looking at the daily data points, we do see that shorter term, this is a classic, typical bounce level for the IXG. So here I am comparing the XLF with the IXG, and the XLF has, outperformed the global financials ever since November 2009. Very clear uptrend. It has made no sense to be in the global financials versus the XLF. Yeah, a pretty clear trend, frankly. Higher highs and higher lows. Now let's look a bit at the seasonality of the pair. Yes. Okay. We do see that the XLF tends to outperform into early October, then pull back a bit, and then come back strong. Let's quickly compare the global financials with the VT, which is the total stock market ETF. We do see some kind of bottoming behavior here, but it's a bit of a messy chart as well, so it's not clean by any stretch of the imagination. But we have gone from a clear downtrend here from late November 2019 to late 2020. We have seen a bit of an uptrend-ish behavior from global financials. Looking at the seasonality, financials, they do tend to outperform here into later into the year. That's definitely interesting. In this case, I do give the bulls a 5 here on relative performance. So we do end up with a 4.8 now in favor of the bulls. The entry signal stop loss is though 200 weekly moving average, which is definitively a bearish level. But the issue is that, issue for the bears is that we are oversold on RSI, and we saw that even during the downtrend, that has triggered rallies. So there's that. So we do have some time left. So let's just scan through some of the charts in the XLF. The first on the list is Berkshire Hathaway. In this case, we definitively have a head and shoulders pattern that now is confirming itself. pretty significant head and shoulders. This is on the weekly data points, so it does definitely have more gravitation. If you look back here in 2000, right before the global financial crisis, we did get a head and shoulders on the Berkshire Hathaway. So head and shoulders, not really good for Berkshire. Any person who looks at this chart and looks back is going to be like, uh-oh, that's not good. So there's that. JP Morgan is another one. Here is that stock. Yeah, in this case, we have seen a very significant downtrend, major pullback. So let's look a bit here at RSI and PPOs. So if you look at like the red 200-week PPO and also the blue 100-week PPO, if you look at the previous time, we had these levels. It formed a key low for JP Morgan. Also back here in 2011, back here we had these readings. Also here on the green 50-week PPO. So there's that. So the bears are clearly still in control, but the indicators here, the long-term indicators, do suggest that there could be a bit of a rising phase. On the daily data points here, you can see on RSI, we have reached a level that has a tendency to create bounces in this primary downtrend. Next on the list is Bank of America. Here is, the big picture. Definitively been through a lot. Even though it is a very large company, you can see that it can very quickly have some big moves. Like here as an example, well, like if we measure from here, like here to here, minus 32%, and that was during a primary bull market. It's all of a sudden had its own bear market. So in this case, we have lost a lot of support levels. We are falling back into a bit of a cluster of potential support levels from 2018, 2019. And the dailies here, the bulls, at least, they want to use support. Bears want to break support. But the bulls, they do have an opportunity here to form a double bottom. So there's that. It's an opportunity here on Bank of America. Let's look at Wells Fargo. Like that. Yeah, this is messy because on the one hand, you do have a super big inverse head and shoulders pattern. Very big. If it forms, that would be bullish. But this chart is just a mess. A lot of resistance levels above us, moving averages, horizontals. Looking at daily data points, this is very it's messy because on the one hand you do have a very major rounding top pattern. You also have on the dailies also formed a bit of an inverse head and shoulders pattern that did fail. So there's just a lot of conflicting signals and sentiment in this stock, so it can become erratic. Then we go to Charles Schwab Corporation. Yeah, a bit of a head and shoulderish pattern here as well. A bit of a shoulder, a bit of a head, a bit of a shoulder. You see here that the blue 100-week moving average, it is forming a bit of a support level. So there's that. It hasn't lost that support, but it hasn't been able to really rally from that support either. Looking at the daily data points, we then have the green 50-day moving average here forming support. Then again, you do have surgical resistance from the red 200-day moving average. So it's a bit messy. You do have support, but you also have very clear resistance. So in this case, we have looked at a bunch of stocks. We've looked at the ETF, really done a bit of a deep dive here. There's definitively a lot of interesting things happening with the financial services, both global and US based. The issue with the market at this point is that it is very erratic because there's huge geopolitical events happening on a weekly basis now. So you do have the charts, you have the fundamentals, but geopolitical events, they will obviously have a lot more gravitational force than any like moving average or something like that. So It's messy, but the analysis here did find some interesting things.